Hello, this is Corner Invest. Welcome back to the show. So in today's video, I'll be covering mainly three things over here. First one, Nvidia might be in trouble. Second one is Uber a buy today. And third one, we'll be covering the stock market outlook over the next few weeks or so. So first topic, Nvidia might be in trouble. So Nvidia's revenue over here has been exploding over the past 1 year or so. So if you're to just look at their revenue over the past 20 years or so, it's been on an uptrend, it's been on a slow and steady uptrend. And then in the past 1 or 2 years or so, it has exploded. So their revenue basically front dated 26 years of earnings in the past. And I don't think this is very healthy. This is scary for any company with such explosive growth. So for Nvidia right now, there are three main narratives that is sort of like pushing down the stock. So the first one is that DeepSeek showed us that a lot more could be achieved with a lot less. And then you have your AI capex spend, which will crater one day, as well as basically we are in an uptrend now. We don't want to catch the downtrend, and that is why people are exiting the stock today. So Nvidia and CoreWeave, they basically did an IPO last Friday. I think it's a bit shady. So Nvidia has a stake in CoreWeave. They pay CoreWeave to have the stake, and then CoreWeave they use that money to go and buy Nvidia's GPU, and then Nvidia use the GPU money to go and pay for services that CoreWeave provides, and then CoreWeave they use the GPUs that they got from Nvidia to basically raise more debt. So it's sort of like a Ponzi scheme, trying to get money out of retail investors through the IPO, and trying to get more money through debt by using your GPUs to back it up. So for CoreWeave over here, the IPO at around a 17 times price to sales. I think it's extremely high for any business. 17 times price to sales is not cheap. And this company over here, it was a Bitcoin mining company a few years back, and now it's a Gen AI company. So it's a bit shady for Nvidia to be involved in this kind of transaction over here. Next one, so you have some Nvidia issues that are popping up already. So if you were to just look at their balance sheet and income statement, so their accounts receivable is increasing much more than their revenue. So the left side is their accounts receivable. The growth is a lot more as compared to your revenue quarter over quarter. So for Nvidia over here, the problem with this thing over here is that if your accounts receivable is rising a lot more than revenue, that means that you are seller financing. You're not collecting the money yet. You are basically realizing the earnings without actually taking the money in from your buyers and all that. And that could be dangerous because if all those buyers they somehow turn bankrupt and all that, or they have some economic problems, then Nvidia's earnings will take a hit next time as well because they have to write it down as well. So second problem over here is your capex spending issues. So last week, Microsoft basically they abandoned some data center projects, and we could see a lot more data center projects coming down if there is overcapacity instead of over demand. Last one, AI will eventually be commoditized, and if you're to just look at what AI has benefited us humans today, the only real benefit that we have experienced so far is your Gen AI. There hasn't been sort of like a push to like improve our ways of life. And if AI is commoditized, then Nvidia's GPU margins will definitely take a hit. And if you're to just look at today's Nvidia as compared to like Cisco in 2000, they are both creators. Nvidia is the creator of AI, Cisco is the creator of telecom, but normally the creators don't win. The ones that win, they are the distributors. So for AI today, I don't think Nvidia is a very good stock for you to invest in because it is extremely risky. I'll talk about this later on as well. So if you're to just look at every major innovation over the past 50 years, 100 years or so, there's always been a reality check. So take for example your 2000 dot-com crisis. The internet is a revelation, but the problem was there was overcapacity, and all these telecom companies they just build and build and build without real demand for it. And that may be what we're seeing today with AI as well. AI could be a revelation. It could change our lives maybe 10, 20 years down the road, but there will always be this reality check that comes up before something tangible actually happens. And that could be what we could see in AI if this AI bubble basically pops. So the bull case for Nvidia is this: your AI capex is skyrocketing and the demand is still there. So Sundar Pichai, your Google CEO, in the last earnings call, they basically said that there's more demand than supply right now, and that's why they've been ramping up their capex. And then you have Nvidia's chips, which is much more superior to AMD, and they're branching out to other sources of revenue as well, which is outside of data center. So they have collaborations with GM on automotive AV, and then you have Uber collaborating with Nvidia as well. So they are basically trying to branch out all their data center revenues into other streams, which is what I like to see. But they're still extremely dependent on AI data center revenue. So for Nvidia over here, if they're able to grow 40% this year, they're projected to grow about 40% this year. A 35 PE for this company is actually quite cheap. And if you're to just look at the valuation of Nvidia over the past 5 years, I think it is on one of the lower ends as well. So this could be a good time for you to enter if you're looking to buy Nvidia stock. But for me, Nvidia is a very risky bet in terms of AI because it's too dependent on AI, with almost everything now dependent on AI. So what if AI fails? What if AI doesn't go as planned? What if we are in a bubble? Nvidia will be the first one that comes down because it was the one that led this AI hype cycle. And for me, I don't feel comfortable owning a company that is 100% dependent on AI. And that's why I'll avoid Nvidia for now. Next one is Uber. So Uber is an interesting one. It is a company that is growing, but it faces a lot of competition with a lot of disruption risk. So you have Waymo that is already doing 200,000 paid trips every single week, and then you have Tesla as well, which is basically expanding their robo-taxi fleet. So for Uber over here, more than 50% of its revenue comes from mobility, where they collect commission from the drivers. So what if next time we have AVs, and then if there's AVs, then your prices for your rides will drop a lot. That will hurt Uber's earnings because when your dollar cost for your trips drop, then the dollar commission that Uber receives as well will also drop. So the only way for them to maintain this is for volumes to increase, which will increase, but there will be a certain limit because you can't have too much cars on the roads anyway. So for Uber's bull thesis over here, this is what management laid out in the last Investors Day. So they're projecting around 30 to 40% CAGR in terms of their adjusted EBITDA growth and 90% plus in terms of their free cash flow growth. So this is Pershing Square, the Uber TC. So what they're saying is Uber is trading at a 29 times earnings. It's extremely cheap right now, and it is projected to have around a 30% EPS growth over the next few years. And yeah, your gross booking is increasing, and then your revenue is increasing around mid to high teens as well. So for them, for Pershing Square and for Bill Ackman, they think that Uber is an outsized bet right now as compared to the risk that is associated with this business. And they are saying that basically AV will not advance as quickly as expected. AV will have a lot of players in the AV segment, and that is why Uber will be the winners in it. But if you were to just look at all these different arguments over here, all they are saying is just AV is flawed. That's all. They're not highlighting anything substantial that Uber will do in terms of the AV market, but they're just saying that the AV market is flawed, and that's why it is a buy for Uber today. That's what they're saying. But for me, I think if you were to just look at Uber's valuation, Uber is currently trading at around a 54 times earnings. So they have these two portions over here, which is quite ambiguous. So over here they included other income as well. Other income is when they try and revalue all the different stakes in like Grab and all the different other companies that they own as well. And then they have a provision from tax benefit. So if you were to just discount these two portions of their income, they're actually trading at a 54 times earnings. I think it's extremely high for a company that has existential and disruption risk. And yeah, that's why you see Uber's P now, which is at around 15 times. But if you were to just look deeper into their income statement and their balance sheet and all that as well, it's not as good as it seems. Next portion over here, free cash flow. So free cash flow over here, price to real free cash flow is around 50 times. If you were to just look at Uber's cash flow statement over here, they have this portion over here, which is your accrued insurance reserves. So this portion over here is basically the money that Uber receives is sort of like a float for insurance, but it is not actual money that Uber can use to go and do buybacks, go and do dividends and all that. So it is not earnings that is attributed to the shareholders of the company. And so if you were to just discount this portion as well as the 33% stock-based comp, which is this portion over here, Uber is currently trading at around a real price to free cash flow of around 50 times. That is extremely elevated for a business like Uber, despite it growing at around a 30% year over year. So for me, Uber is a risky one. On the surface, you have many other YouTubers saying that it is cheap because they see the price to free cash flow of around 20 times right now. But if you were to just look into the numbers deeply, I think it is not cheap at all. It is a company that's trading at 50 times real price to free cash flow, 54 times real earnings, price to earnings. And yeah, for me, especially for a company with disruption risk, I don't think it is a buy right now. It is a company that just turned profitable. Of course, it could grow a lot more, but yeah, for me, it's an avoid. It doesn't have a strong moat in its business. Last portion, stock market outlook. So if we are heading into a bear market, then we are in the first month of a bear market. We are currently now around 10% from all-time highs, and we have a lot more downside to go. So a bear market usually lasts for around 9.6 months. We're in the first month, so we have around 8 to 9 more months to go if we actually go in a bear market. So there's been tariff almost every single week. So Trump over here is saying that he couldn't care less about tariffs making prices of cars increase. And so tariffs and protectionism will lead to economic weakness, and we are already in an economic environment that is weakening already. So if Trump continues and he actually follow through with all these different tariffs, then we could see a lot more economic downside. We could see a lot more economic weakness, especially in the data in the next few months. So next one, valuation over here. So if you to just look at the stock market valuation for the S&P 500 and the US market as well, we're currently trading at around 25 times. That is extremely expensive, and it is the second in the entire world. And for me, I think there is some sort of rotation out of the US market into international markets already. Because all your international markets, all your international stocks, they're trading at a rather cheap discount as compared to your US markets. And the animal spirits has died as well. So this is the sentiments over the past month or so, and as you can see, it is extremely bearish. But there's a contrarian view, which is that buy when others are fearful, sell when others are basically euphoric. So now everyone is fearful, so maybe it could be a time for you to buy into your stocks right now. But for me, I'm still buying into stocks. It is hard to time the bottom. Just buy on the way down and just let it ride through. So that is what I'm doing right now. I'm setting buy entries, tranches on the way down, and then hopefully it hits all those tranches so that I can buy all the way and then just basically benefit from this entire drawdown over here. But for me, I think high quality businesses, it will just compound over time. This 8 to 9 months drawdown wouldn't be much of a problem for all these businesses. Actually, I hope we go into a bear market so that all these prices come down so that we get more discounts. But yeah, for me, I'm just buying high quality businesses and allowing them to compound over time. Doesn't matter if they drop 10%, 20%. As long as the fundamental stays where it is right now, I am comfortable holding them through.